Hey, what is going on, everybody? Welcome back to Bonafide Investing. What I want to do today is talk about some of the changes I've made to the portfolio since the weekend, some moves I made, the reason I did them. I also want to look at two specific holdings, which are my cash buffer, as well as my long bond, why I hold them and what they do for the portfolio. So why don't we dive in? Currently, you can see the portfolio value is sitting at $381,000. I'm using a little over $121,000 of margin, as you can see here. Options collateral, these are for some of the puts that I bought today. And the pending orders, that is due to the dollar cost average. I'm buying $200 into the exact percentages of my current holdings. And I'll explain more of that as we go. So keeping my current margin buffer a little over at 59%. I really don't like falling below that 50% mark. It's usually higher. However, your options collateral will eat into your margin buffer. So it's something I'm always mindful, something I'm always watching. So what I did today, this morning, I sold a put on Bristol Myers, BMY. It is a blue chip pharmaceutical company. Reason I bought it is because they've just been absolutely hammered as of late. And down into the mid to upper 40s, it looks like they're finally finding potentially some support. So I sold the $51 put expiring this Friday to generate some income for the portfolio. I also sold the $69 put on Coca-Cola. Coca-Cola, in my opinion, really hasn't gone anywhere in the past 5 years. They're more or less sitting where they've been on the charts. So selling the $69 put expiring this Friday as well will generate some more income for the portfolio. Now, these are two companies I would never mind owning. So if they do fall to, for example, Bristol Myers falls to $51 or lower, and I input the shares, I'm happy to own them. And what I'll do is turn around and sell a call on those positions to generate more income for the portfolio. PG&E is a utility company. They just function as a typical utility, so very low volatility. However, I sold a put on that position as well, expiring this Friday to generate more income. AT&T, as well as Verizon, two communication giants. I wouldn't necessarily call them blue chips. I would refer more to them as utility companies, low volatility, steady cash flow via dividends. I can't remember the last time I met anybody who did not have a cell phone or internet. So feeling pretty confident to sell puts on those two positions to generate some income for the portfolio as well. And Conagra Brands, they are a food manufacturer and distributor, sold a put expiring next Friday, the 19th, to generate more portfolio income. I also bought a $500 put, about 20% out of the money, meaning I bought it about 20% below the current market price on it. And the reason I did that is basically just market crash insurance. Just like I own fire insurance on my home in case it burns down, I want to own portfolio insurance. So I bought a position on the Qs, which will, in my opinion, shield any large downside market correction or crash over the next couple of years as this expires the end of 2027. So I bought what's called a LEAPS put option on the Qs to shield some of my long positions that I have throughout my other holdings. Did the same thing on the SPY. I bought a 20% out of the money put from the current market price. Reason I did it, we have the Fed meeting coming up this week. Could trigger a little volatility in the markets. I think the markets still will melt up. I think there's still a lot of fear in the markets. So that tells me I don't think the top is in quite yet. We could see some downside this week. We're seeing a slightly downside day today. I think the NASDAQ's down about 0.3%. So we could see a down week, maybe potentially even a down December while people rebalance, take profits, what have you. However, I still think there is more room to go up. The CNN Fear and Greed Index, though not a perfect index, still tells us there is fear in the markets. And I use that as a gauge to, kind of get a feel for market sentiment, where things are currently at. So I do think we will go higher. If we do go higher from here, which I expect, I will be buying another QQQ puts as well as another SPY puts, pretty close to, again, 20% out of the money or below, wherever the current market price is on that as well. Now, what I wanted to talk about today was specifically TLTW, as well as SGOV. These are my long bond positions as well as my cash cushion between the two. What I currently have is I'm currently allocating 10% of the portfolio to TLTW as well as 10% to SGOV. We'll start with TLTW. Let's break this down a little bit further. And what TLTW is basically what the title says. It is iShares management. They are buying the TLT, which is the long bond, the 20-year plus bond, and they are basically writing calls on it, right? So what that does, it generates higher income than you would typically get on a roughly, 4.1 to 4.2% long bond. What this has so far historically yielded is closer to about 12% on average. Now, the distributions do fluctuate. Keep that in mind. For example, the November distribution was much higher than the December distribution. But going back, I generally say it's about a 12% distribution as of now. Could be higher, could be lower. So I like that. I like that 12%. What that 12% does is it helps cushion my 4.75% margin that I'm currently borrowing at. So I like that spread. Long bonds also have typically historically been a good deflation hedge. So think 1929, think 2008, right? Those two periods when we had a lot of deflation in the system where the value of assets fell drastically, long bonds typically held up pretty well. No guarantee that'll be the case in the future, right? But again, want to use that as a deflation hedge across the portfolio. Now, I really do think long rates will probably rise in the short term. I think they will go higher. I think there's a potential for inflation to go higher. But that doesn't scare me out of the position as I'm currently buying into this every single day. So I'm currently buying $20 of the $200 that I'm dollar cost averaging into the portfolio. So again, about 10%, try to keep that allocation. So currently I own 2,176 shares. It's about 10% of my portfolio. It is down today as rates have risen. But the total return is very misleading on Robinhood. I've had thousands of dollars of distributions from this ETF so far. So the minus 861.89 is a little bit misleading as I have a total positive return if you factor back in the income that I do receive from TLTW. So that's TLTW, the position I have in it, why I use it, why I think it's really important for a high yield portfolio to have some exposure to TLTW. Again, not financial advice. Please make your own financial decisions. These videos are never for any sort of financial advice. They're, again, just to educate and inform. So a little overview on TLTW that I wanted to touch on there. If we go back, the next ETF I want to look at is SGOV. SGOV is my current cash buffer, whatever you want to call it. This tracks short-term treasury bills, generally 0 to 3 months, as it says, and there's really little to no volatility whatsoever. This holding actually, again, another 10% target for the portfolio. This will act as downside, any market downside hedge, deflation hedge. This is the only holding that I currently have across my ETFs and closed-end funds that yields lower than what I'm currently paying on my margin. So right now, I'm paying 4.75% margin interest on, like I showed you earlier, about $120,000. This is currently yielding about 4%. No big deal. If I have to lose that negative 0.75% for a slightly bigger buffer across the portfolio, not going to break the bank, I don't think. So what I want to use SGOV for is when the markets do sell off, when we do have those downside corrections, especially those little ones, 10, 20, 30%, I want to deploy some of this cash into my high quality ETFs that are long in exposure, meaning do better when markets go up in value. So that's what SGOV does. Currently, I own 497 shares. This is, again, another 10% exposure, like I mentioned. and I'll be dollar cost averaging about $20 into this ETF every market day as well. So SGOV, again, we have the short-term rates, I should say, potentially being affected by the Fed decision that will come out this week. The Fed meets right now. The market has about a 95% probability that the Federal Reserve will cut rates by 0.25%. And what that could do to SGOV is potentially lower the distribution in relation to that. The Federal Reserve can only control short-term rates. So SGOV will be more impacted by what the Fed does, right? Whether they raise rates, lower rates, keep rates steady. That's going to affect SGOV much more than TLTW, right? TLTW really won't be affected by what the Fed does. It's more dictated by what the market sets long-term rates at. So I like that spread. I like having, roughly 50,000 in one, 50,000 in the other. So that way I can get that higher yield from TLTW. Altogether, they yield about 8 to 9% annually. So I think they're both very safe positions, as well as they're paying about double of what I'm paying in margin. So that's a nice buffer there. So looking out, what I want to do in the next video, I want to talk a little bit about some of these other holdings, why I hold them, what they are, what they do for the portfolio. But hopefully you got something out of us covering, the changes I've made, the reasons I did them, as well as the cash and bonds exposure that I hold in this high yield portfolio. So again, the goals of Cash Flow Life is paying my bills. So far, so good. Minimize risk the best I can. Again, we can't minimize risk 100%, as well as use margin to boost returns, but also use margin responsibly. So I guess paying down the margin, paying the bills is two big goals, I guess, of Cash Flow Life, if you want to look at it that way. So thanks for being with me today. Hope you got something from this video. Have a great day.